Welcome to this class on the financial performance measurement. This is part 2 class on financial performance measurement, and we'll deal in particular with static indicators. So static indicators of performance are punctual measures of performance in a precise moment in time. They are different from dynamic indicators that we'll analyze instead in the following classes, because dynamic indicators evaluate a project on the basis of the whole life of the project, differently from static indicators that instead refer to a specific moment in time. So in this class, we'll see that there are 3 types of static indicators that we can define as rate of return, financial ratios, and risk-related indicators. So the rate of return say how effectively the resources implied in the project are managed. The financial ratios are measures of financial performance. Risk-related indicators are tools for risk assessment, so to measure the risk of this project at some points in time. So we start from the rate of return, and we can see that rate of returns can be calculated in different perspectives. Can be calculated in perspective of all the investors. So in this case, we'll calculate the rate of return on the invested capital. That includes both loan and equity. Or we can calculate rate of return specifically for equity holders. And we'll see that we'll have 2 different measures accounting for the 2 different perspectives. So as concerns the rate of return from investment, we have a ratio that is defined as return on investment, or ROI. The ROI is calculated as the ratio between the EBIT and the invested capital. So the EBIT, as we have seen in the previous class, is the operating profit and can be calculated from the projected income statement, as we have seen. And it's the difference between revenues and operating costs. All operating costs, including depreciation. Invested capital, as we have seen before, is the total capital invested into this project, and is made by fixed asset plus net working capital. Or, as we have already discussed, it can be also interpreted as the sum of loans and equity. So it's basically the total capital that has been invested by shareholders and creditors into this project, and can be calculated on the basis of the projected balance sheet, as we have seen in the previous class. So the ROI measures the return of the project on the total capital that has been invested. So for example, if the ROI is equal to 10%, this means that for each dollar of total capital invested into this project, there is a return of 10 cents per year. If we want to measure instead the return for the shareholders, we have to calculate a different ratio that is defined as return on equity, or ROE. So the ROE is equal to the ratio between the net profit and the equity. So the net profit is the last line of the income statement, as we have seen in the previous class, and is equal to the difference between the revenues and the total cost, including income taxes. The equity instead is the total investment made by the equity holders, and includes both the original investment and, as we have seen in the last class, the retained earnings that are equivalent to an investment made by equity holders, because they are basically dividends that the equity holders have decided not to pay to themselves, but to leave in the firm for future investment. So the net profit can be taken from the projected income statement. The equity can be obtained from the projected balance sheet at a given year. And the ROE measures the return on the capital invested only by shareholders. So that's why it's different from ROE or ROI, because the ROI instead reflects the return for the capital invested by all the investors. So an ROE of 10%, for example, means that for each dollar of investment made at that point in time by shareholders, they will receive a return of 10 cents in that particular year. So the second type of indicators is defined as financial ratios. Financial ratios, as I was saying before, are measures of financial performance of a project at a given moment in time. We have different types of financial ratios. The first type of financial ratio is defined as profitability ratios and are measures of the profitability of a project at a given point in time. A first profitability ratio that is defined in this slide is the operating profit margin in percentage that is calculated as the ratio between EBIT and revenues. So EBIT is always the operating profit that has been calculated in the income statement at a given moment of the life of the project, and revenues are basically the first line of the projected income statement, and they reflect the revenues that are expected for the year for which we are calculating the operating profit margin. So this index is saying to us how much EBIT the project is generating for $100 of revenues. So an operating profit margin of 50% means that for $100 of revenues we'll have $50 of EBIT, and this basically also means that $50 of these revenues will be absorbed by operating costs. So operating profit margin of 50% means that they have revenues for $100, of which $50 will be absorbed by costs, and 50% will remain instead as EBIT, as margin for the project, operating margin. The net profit margin in percentage is a ratio that is similar to the previous one, but instead of being calculating on EBIT, it's calculating on the net profits. So it's equal to net profits, to the ratio between net profits and revenues. So the difference between the two indicators is that the net profits include all the costs, not only the operating costs as it happened for the EBIT. So net profits are typically lower than EBIT, also because they include income taxes, as we remember from the structure of the projected income statement. And so typically net profit margin is lower than the operating profit margin. So the denominator is basically the same for the two ratio, but net profit are different and typically lower because they include costs other than operating costs, and in particular financial costs and income taxes. Typically these ratios are used to compare the profitability of a project or a company with other project or a company in the same industry, because there is not a given standard of expected profitability for a project, but what matters is the relative profitability. So the profitability of the projects compared to other projects having the same nature, so typically other projects in the same industry. So these ratios are used to understand whether the expected profitability of this project is higher, lower, or in line with the profitability of similar projects. A second category of financial ratios is activity ratios. So activity ratios help us to understand how efficiently some specific assets are used into the projects. Here we have 4 different types of activity ratios, of which 2 are described in these slides. The next 2 are described in the next slides. In particular, the first activity ratio that we describe in this slide is the inventory turnover. The inventory turnover is equal to the ratio between the cost of goods sold and the average inventory. So let's give a more precise look at these 2 variables. So the cost of goods sold is typically the variable cost that is generated by the production. So it typically includes raw materials and the direct labor cost and other production costs that vary with the production. So cost of goods sold is included in the variable cost that we've seen in the structure of the projected income statement in the previous class. The denominator is average inventory. So the average inventory is the average level of inventory that the firm will keep for this project during the years of interest. And the meaning of this ratio is the following. This ratio is saying to us how efficient is the firm in managing the inventory. Because the lower is the inventory as compared to the cost of goods sold, the higher will the inventory turnover will be. So in theory, you would appreciate a higher inventory turnover, because this means that given the level of cost of goods sold that the project is going to generate in some future year, you are able to have a lower level of inventory during the life of the project. So you are more efficient in the management of inventory. So here you higher rate, a higher value for this ratio is desirable for project performance. The second activity ratio that is represented here is the asset turnover ratio, that is equal to the ratio between revenues and total assets. So as we already said before, revenues can be taken from the projected income statement, whereas total assets can be found on the balance sheet. In particular, they are the total of all the assets reported in the left section of the balance sheet that we have seen in the previous class. So what is the meaning of this ratio? So basically this ratio is saying to us how efficiently the assets of the project are employed in order to generate revenues. So also in this case, higher value of this ratio is desirable. And the reason is that when you have higher asset turnover, this means that you are able to produce the same level of revenues with a lower investment in total assets. So if, for example, revenues are equal to 100 and total assets are equal to 100, this means that in order to produce revenues of 100 in a given year, you need the total investment in fixed assets of 100. And so the asset turnover will be equal to 1. But if you are able to attain a higher asset turnover ratio, so let's say a asset turnover ratio of 2, this means that you will be able to produce 100 revenues for 50 of assets. So you are able to have an investment that is the half of the investment that will be required in the previous case. Or for the same investment that was 100, you could have double revenues, because you could have 200 revenues. So having a higher asset turnover ratio means that the project is able to generate revenues with a lower investment in assets. So a higher level of asset turnover is highly desirable for project performance. Here we have two other activity ratios that refer to receivables. In particular, we have receivables turnover and receivables collection period. So let's look at the first ratio, that is receivables turnover. The receivables turnover is equal to the ratio between revenues and the average level of receivables generated by the project in the year of interest. Revenues, again, are the revenues predicted by the income statement in a given year of the life of the project. Whereas the average receivable is the average level of receivables that I will find in the balance sheet of the project in that particular year. So what is the meaning of the receivables turnover? So this is a ratio expressing the effectiveness of the firm to manage the receivable. So it's a ratio related to receivable policy. And also in this case, you want a higher level of the receivable turnover. So a high level of receivable turnover is desirable for a higher project performance. The reason is the following. When you have a higher receivables turnover, for the same level of revenues, you will have a lower level of receivables, and so you will have a lower need of investment in net working capital, as we know that the receivables are an important component of net working capital. So when receivable turnovers increase and revenues are constant, this means that you will have a lower value of receivable for the project in that particular year. So if you have, for example, a receivable turnover equal to 1, this means that for each $100 of revenue, you will have $100 of receivables. But if you have a receivables turnover of 2, this means that for $100 of revenues expected for that particular year, you will have 50 receivables. So exactly the half of what you had before. So this means that you have reduced the financing need to cover receivables in that particular year, and you have reduced the investment required in net working capital. Another way to look at the receivable policy is the receivable collection period. So the receivable collection period is equal to the ratio between receivables and average daily revenues. Receivables are the receivables that you have in a particular year of the life of the project. And average daily revenues are just the revenues that the project is expected to generate in that particular year, divided by the number of days in a year. So this is basically saying how much revenues you are generating in each year of the project, however, assuming that you generate the same amount of revenues for each day of the year. That is quite a strong assumption, but gives us the first idea what is the average daily revenues. So if you divide the receivables times the average daily revenues, you get a number that expresses the number of days after which you collect receivables. So let's make an example. Let's assume that the receivables are 100 and that average daily revenues are equal to 1. So this means that the receivable collection period is 100 days. So basically the firm employs 100 days to collect the receivables, and clearly this is an important parameter for determination of net working capital, because the higher the receivable collection period is, the higher is the need for receivable, the higher is the investment in net working capital. So in this case, for a project, you will prefer to have a lower collection period, because when you lower the collection period, you will be able, ceteris paribus, so given the revenues, to reduce the investment in receivable, to reduce the investment in net working capital. So now we have the third category of static indicators, that are the risk-related indicators. And here we can see that we have different types of risk-related indicators. The first type of risk-related indicators is the payback period. So the payback period is the time required to recover the investment outlay made at the beginning of the project through cumulated net cash flows earned by the project. So in order to calculate the payback period, we have to refer to the cash flow statement to understand after how many years you are recovering the initial investment that is made for this project. So in this case, we are not referring to the income statement or to the balance sheet, but we are referring to the cash flow statement. The reason why the payback period is a risk-related indicator is because when a project has a longer payback period, there is a higher risk of not recovering the investment. In fact, typically, by definition, the cash flow that are earned at a later time are more uncertain and riskier. So if the ability to recover the initial investment is more based on cash flow that are more distant in time, this means that the project is riskier. because there is a lower likelihood to recover the initial investment. So typically, risk-averse investors prefer to recover the investment earlier, so they prefer projects with lower payback. So here we have an example of payback calculation. So we are assuming in this table to have a project that has a life of 3 years. So the initial investment is here 0, and then the project is generating cash flows for year 1, 2, and 3. So the project is an initial outflow of minus 100 at time 0 for initial investment, and then it has 3 inflows of 50 in year 1, 30 in year 2, and 30 in year 3. So in order to calculate the payback period, we have to calculate the cumulative cash flows. So the cumulative cash flow that we read in the last column on this table, clearly near 0 is equal to minus 100, that is the cash flow that I have times 0. In year 2, the cumulative cash flow is equal to the net cash flow that I had in time 0 minus the minus the inflow that I have time 1. So I have minus 100 plus 50, I have minus 50. So at time 2, the cumulative cash flow will be equal to the cumulative cash flow at time 1 plus the inflow generated at time 2. So it will be minus 50 plus 30 minus 20. And finally, in year 3, the cumulative cash flow will be equal to minus 20, that was the cumulative cash flow at the year before, plus 30, that is net cash flow at year 3, and so we'll finally have a cumulative cash flow that is positive, and is equal to 10. So how do we calculate the payback period? Well, the payback period is the time in which we recover the initial investment, and so it's the time in which the cumulative cash flow will become positive. So as we can see from the cumulative cash flow, the investment will not be recovered in the first 2 years, because the cumulative cash flow at the end of year 2 will still be negative. And in fact, if you sum the inflow of year 1 and year 2, that give a total of 80, we find that these are not enough to cover the initial disbursement of 100. So you have not recovered yet the initial investment, and so the payback period will be higher than 2. So the project will require more than 2 years to be recovered. So as we can see, the cumulative cash flow at year 3 instead is positive. So this means that you recover the project during year 3. However, the cumulative cash flow is higher than 0. So this means that you recovered the initial investment before year 3. And if we assume that the cash flow is generated constantly during the year, so in each day of the year it generated the same amount of cash, we can calculate the payback period as explained in this formula. So the payback period will be equal to 2, that are the first 2 periods where you don't record the investment, plus 2/3 of the 3rd year, because if you assume that the cash flow of year 3 is generated constantly over time, then after 2/3 of the year, you will have generated 20 of the 30 of total cash flow of year 3. And so after 2/3 of year 3, you will have recorded your investment. So the payback period in this case is equal to 2.67 years. And this means that after 2 years and 0.67 years, you have been able to recover your initial investment. Clear, the payback period is a very rough indicator of the risk of a project. In some cases, it's a useful indicator because it's anyhow a useful information for the investment to know when the initial investment is recovered. But if you apply the payback period as an objective indicator for project selection, this can create some problems. The reason, so the payback period has some limitations that are clarified by this example. So let's take three different projects that we name Project A, Project B, and Project C. all these projects have an expected life of 3 years. So you have an initial investment for the 3 projects made in year 0, and then these projects are generating cash flows for 3 years, that are year 1, year 2, and year 3. All the 3 projects require the same initial investment at time 0, that is minus 2,000 for the 3 projects. But then they produce different cash flows during their life. Because project A has an inflow of 1,000 in year 1, an inflow of 1,000 in year 2, and an inflow of 5,000 in year 3. Project B, instead, is a no inflow at time 1, and there's an inflow of 2,000 at time 2, and an inflow of 5,000 at time 3. Project C is similar for the first 2 years to project A, because there's an inflow of 1,000 at year 1, an inflow of 1,000 at year 2, and then differently from project A, it's much bigger inflow in year 3 that is equal to 100,000. We can easily find that all the 3 projects have a payback period of 2 years, because you can easily see that for the 3 projects, the initial investment is recorded at the end of year 2. Because here you have accumulated cash flow of year 2 of 2,000, 1,000 plus 1,000. So at year 2, the accumulated cash flow is equal to 0, and you have fully recorded initial investment. Also for project B, the accumulated cash flow at time 2 is equal to 2,000. So, it's equal to 0, because in year 2 you have an inflow of 2,000 that fully covered the initial investment. And also for project C, you have accumulated cash flow equal to 0 at year 2, because the 2 inflows at year 1 and year 2 are equal to 2,000 and are able to recover the initial investment 2,000. However, so apparently, just looking at the payback period, the decision maker could be indifferent between the projects. So the 3 projects would be equivalent, and if you had to choose, you have no clear indication about which project you should choose. However, it's clearly understandable that the 3 projects are very different, and that in particular, project C is much more convenient than the other ones. You can see that, in fact, the inflow of project C at time 3 is 20 times bigger than the inflow of both project A and project B. So even without applying a more sophisticated valuation method, we can easily see that project C is more convenient than project B and project A, but this does not absolutely appear from the application of the criterion of the payback period. And this is for a very simple but very important limitation of the payback period, is that the payback period is not concerned about what happens after that the payback period is reached. So in this case, for the 3 projects, the payback period is reached at year 2. So the payback period is not concerned at all about what happens in year 3 or in the eventual following years. And it's exactly what happens in year 3 that in this particular case makes the difference between project A and B and C, and in particular makes project C much more convenient than project A and project B. So this is to say that payback period can be a useful indicator as a first assessment, for a first assessment of the risk of the project, and in particular for the risk of not recovering the initial investment. But once that you have analyzed the payback period and you got this first useful information, you should not use the payback period as a unique and objective criterion to decide among alternative projects, because you could make serious mistakes, as it is clear from this very simple example. So another category of risk-related indicators are the liquidity ratios. The liquidity ratios are ratios that give information about the liquidity of the project in the short term, and so the financial sustainability of the project in the short term. Here we have 2 indicators, 2 liquidity ratios that are the current ratio and the quick test. So these ratios have very similar meaning with an important difference that we'll discuss in a moment. So let's start from the current ratio. So the current ratio is the ratio between current assets and current liabilities. The current assets and current liabilities of a project at a given moment in time can be drawn from the projected balance sheet that we have discussed in the previous class. And this ratio gives us a very important information. It gives us the information about the ability of a firm to satisfy the current liabilities through the current assets. So this basically says if the firm is able to repay current liabilities through the current assets. Because in the current assets you have inventories, repayable, you have receivables and cash. Receivables will be probably collected in less than 1 year. Inventory will be sold in less than 1 year. So you will use these proceedings and existing cash to pay back the current liabilities. So this is the logic of this indicator. So if the current assets are higher than the current liabilities, the firm is relatively safe, and in this particular, you are relatively sure that you can satisfy the financing needs coming from current liabilities in that particular year. So remember that in current liabilities we have short-term borrowing and payables. So this ratio should be typically higher than 1, but significantly higher than 1, because if this value is too close to 1, then we have a liquidity risk. So it could be that if happens something with the collection of the receivable or with the sale of the inventories, and so the collection period increases, so I'm not able to sell the inventories, I could have problems in paying back the current liability. So this ratio is not only has to be higher than 1, but is to be significantly higher than 1 in order to be sure that I will be able to pay the current liabilities. So the quick test is a similar ratio that has also a similar meaning, and indeed is calculated in a similar way to the current ratio with an important difference. An important difference is that we subtract inventories from the current assets. So we say that in current assets we have mainly cash, receivable, inventories. This means that now in the upper part of this ratio we have only cash and receivables. The reason why we are subtracting inventories is because inventories are the less liquid component of the current assets. So if you want to calculate a ratio that is more precise in saying to us whether we are able to face current liabilities, then we are only to concentrate on the more liquid part of the current assets. So also in this case, therefore, the quick test is to be higher than 1, but is to be higher than the current ratio, because it's now we are, can be a bit lower than the current ratio, because it's now we are eliminating the less liquid component of the current assets. We can have a ratio that is anyhow higher than 1, but as we know that cash and receivable are more liquid, we can afford also having a quick test that is a bit lower than the current ratio, but anyhow higher than 1. Another category of leverage ratio are the debt to equity, debt to assets that are represented in these slides, and then the fixed assets coverage and debt service coverage that will be described in the next slides. So the debt to equity, that is the first ratio in this page, is calculated as ratio between total liabilities and equity. Both these items are calculated when we build the projected balance sheet, and it's an indicator that says to us how much debt you are using for each dollar of equity. So this means that if you have debt to equity of 2, for each dollar of equity you will have $2 of liabilities. So the problem is that taking too much debt could be risky for the project, and so this indicator allows us to choose the appropriate amount of debt that the project can stand. In this case, there is not a standard, so we cannot say what is the threshold for the critical threshold for having an unsustainable risk, because the ability of a project to sustain that depends on several characteristics, including the stability of the cash flows generated, the industry, and so on. But typically you compare, in order to have useful information, you compare the debt to equity of your project with debt to equity of other activities, project of firms that have the same nature, the same characteristics, or are in the same industry. So to understand whether you are taking too much debt, or you can apparently increase your debt because your debt to equity ratio is lower than debt to equity ratio of other firms or other projects that are carrying activities in the same industry. The debt to asset ratio is a very similar ratio. In this case, however, you are calculating the ratio between total liabilities as before, but on total assets and not on equity. The meaning of the ratio is basically the debt to equity. Clearly the value will be different. Also in this case, we have not a standard value that says to us what is the threshold for critical risk. But also in this case, we have to compare this ratio with the same ratio calculated for other projects or firms operating in the same industry. Finally, we have the fixed asset coverage and debt service coverage that are the last ratios that we will analyze in this class. And they are mainly aimed to understand whether the debt structure is consistent with the asset structure or with the cash flow generation of the project. So the fixed asset coverage is the ratio between net fixed assets and long-term debt. The word net means simply that fixed assets are taking net of total depreciation, and long-term debt is the financial debt having a maturity longer than 1 year, and something that we find is we already discussed it in balance sheet. So this is just to understand when the long-term debt is covers net fixed assets. So in this particular case, we want that long-term debt is higher than net fixed assets because this allows us to be sure that we will be able to repay debt in the long term. In fact, if long-term debt was lower than net fixed assets, then this will mean that we will not transform fixed assets in cash in time to respect the maturity of long-term debt, and so we could have a problem of financial solvability in the long term. Debt service coverage ratio instead is the ratio between the cash flow generated per period by the project and the total of debt service. So what we mean for debt service, we mean the total payment that we make to serve debt. So it's the sum of principal payment plus interest payment. So what we want is that the cash generated for each period is higher than debt service, because this assures us that the cash flow generated by the project will be high enough to cover the financing need related to debt service. In fact, if cash is not enough to cover that, we could have problem solvability with the bank that could create financial problems for the project. So we want that debt service coverage is higher than 1, so that cash flow will be able to cover the debt services, intended as principal payment plus interest. In particular, typically banks require a safety margin. So debt service coverage is not only to be equal to 1, but is to be equal to 1 plus some safety margin. So for example, 1.5. So the bank is sure that even though the real cash flow will be lower than the expected cash flow, the firm will be, or the project will be anyhow able to repay principal and interest, and so there is no problem of solvability of the project in the long term. So with this ratio, we have finished the class of today. And as always, I remind you that more materials are available on the website of the course. So again, thank you for your attention.